The newsroom right here on ET Now. I'm Ajay Sharma. The markets are in a nice grip of a corrective move in today's session. And though there is attempt of a mild recovery from the lows, overall we are 2/3% down as far as the benchmarks are concerned. Broader markets are taking it a bit on the chin, but power stocks, power related stocks like Coal India, all of them are having a field day. Let's talk about all of that and the triggers which are playing out in the market with a very big voice joining us now. Manish Kumar, CIO of ICICI Prudential Insurance, Life Insurance is joining us. He manages vast sums of money and keeps a very close eye on macros as well as what companies and sectors are doing. So Manish, good afternoon. Let's understand by your thoughts on the worries related to bond yields rising, worries related to sharp shortages of energy and the disruption. All of that, does it, as a money manager, what are your observations? Can it potentially derail the scope of a nice bull run in emerging markets like India? How big is it in your view?
Good afternoon, Ajay, and thank you for the opportunity. Well, I think the last 18 months or so, Indian equity markets have seen one of the strongest runs, right, that we have observed in the last decade or so. And now that bond yields are looking like going up, and I'm referring to US bond yields, could that lead to some kind of risk aversion or some kind of correction in markets? Possibly, yes. But I'm going to call that as a fairly healthy correction, because anecdotally, as retail money managers, what we can see around is there's plenty of money waiting to be invested, which means if there are corrections in the markets, that is going to be used as an opportunity for a lot of investors to come in and join the bandwagon. In any case, markets, it's always healthy for markets after this kind of rally to consolidate a bit and then start moving forward. You also raised questions around rising energy prices, and in a way, can those things derail this kind of rally? Now, please understand that when we look at the market constituents, there are plays which are consumers of energy, and there are plays which are producers of energy. Now, what happens is that if, as a consumer of energy, I'm getting impacted by rising energy prices, yet there is a segment of the market that is benefiting from that, and that act as a balancing factor. And in fact, in the last few months, we have seen a huge surge in commodity stocks, which in a way is also reflecting what has been happening in the markets. So can that derail the rally? Possibly not. But can that cause a pause in the rally or some correction in the markets? Possibly yes.
I would like my director to fire JSW Energy and Tata Power, these two particular power stocks over the last 6-month period. If you look at the graphs, gravity-defying moves are coming in these two companies. Why? Because they are talking the language of ESG. They are moving their portfolios towards renewables at an increasing pace, and the market is also giving them a different multiple now and a sharp rally. But other power stocks in India, Coal India, NTPC, many others probably are slightly behind the curve as far as the entire energy-related initiatives are concerned. They're also trying to keep pace now and move on in that direction. One, how do you see the Indian energy play overall, private sector as well as public sector? And then the second point is on ESG related money, which is coming and positioning itself in some of these stocks like this, but overall coming to ESG related high scoring companies.
So Ajay, I think this is a very, very relevant and an important question that you have raised. And for the benefit of your audience, please allow me some time. So as far as the energy trends are concerned, I think the world is moving towards cleaner forms of energy forms which are more environment friendly, and as such, so for example, the renewable forms of energy, both solar and wind, is something that is really substituting thermal power. As far as automobiles is concerned, diesel and petrol are in some time in the future going to be replaced by electric vehicles. So in a way, I think the trend is very clear. In some countries like the Scandinavian countries, almost 50 to 60% of the vehicles which are sold currently are already electric. So that is the kind of pace at which we are migrating towards environment friendly trends. Now coming to a bigger picture on ESG, and this is where I would like to actually spend some time. Globally, as all know, concerns around environment and social inequity have grown considerably. As a result, both policymakers, the governments, as well as some of the multilateral agencies have been taking a lot of steps and coming up with various protocols to try and see what they can do for the society and the environment as a whole. In this context, we as institutional money managers, since we manage a lot of money in fiduciary capacity, the belief and the expectation from us is that can we, in the process, positively influence our investee companies in becoming socially and environmentally more responsible. Historically, whenever we used to invest, governance was the primary factor which we used to look at besides the business environment and dynamics. Now, society as a whole and what you're doing to the environment have also become equally important. And ESG investing is all about that. In fact, we as a company are already working in that direction. We've come up with a very evolved responsible investing framework, and I can talk about that later on. But right now, the central message that I want to give here is just as institutional investors are moving towards that, we as responsible citizens and as retail investors can also contribute towards the betterment of the society and the environment around us by allocating a part of our savings into companies and portfolios that are either rating high on ESG or those portfolios which are investing in ESG compliant companies. The good news is that if we look at the performance of some of the ESG indices versus the respective mainstream indices in the last 10 years, almost all ESG indices have outperformed the mainstream indices. So in a way, if we behave as a responsible investor and direct our savings in socially and environmentally more responsible companies, not only do we contribute to the betterment of the society and environment around us, it is possibly economically rewarding as
well. Manish, we are very short on time today. A lot of breaking news, so much of corporate developments. So before we let you go, just want to understand that where are you looking at this market where risk reward is attractive? Because we've seen a lot of rally, a lot of positiveness already built in as far as earning goes. Where do you see valuations are reasonable and risk reward is attractive?
So, Ajay, if you had asked me this question 3 months back or 6 months back, probably I would have still said that the valuations are looking rich and therefore one should be prepared for a correction. But then that never really happened. So what we are saying and telling to our investors is that it is good to carry a mix of both debt and equity rather than carrying only equity, and therefore little balanced approach to investing would be a better option. Also, instead of trying to put all money in one go, it's good to average out and invest systematically given the current market levels. If you're looking for an answer as to what will drive the corrections down or what will lead to a corrections in the markets, I would say that it is going to be first global factors, then domestic factors, which means there has to be some kind of global liquidity shock or some kind of a bigger shock than what we saw in China just about a couple of days back. So it will have to be first driven by global factors, and only then maybe because of certain local factors, we may see some kind of correction in equities. Till then, enjoy the ride.